welcome to the latest edition of MPA TV. I'm Matt Sexton, mortgage journalist here with Mortgage Professional America. Today we continue our Broker Intel series featuring discussions with the top mortgage pros across the United States on the most important mortgage topics of the day. We'll hear expert insight and analysis from the brokering industry on a wide range of topics, from regulatory trends to market strategy to everything in between. I'm honored to be joined by three esteemed guests on today's episode. They are Damon Germanides, co-founder of Insignia Mortgage; Tom Wallace, Chief Growth Officer at Edge Home Finance; and Andrew Russell, founder of RCG Mortgage. Thank you all for joining us today on MPA TV. It's time to get to the questions for this episode. We'll start off with Tom. Tom, how are things looking for loan originators in the year ahead? What do you see as the main opportunities for LOs and brokers to grow their market share?
For the years ahead, obviously everyone is talking about AI and what it's doing to aid us all and make things more efficient. I think, the biggest thing for the years ahead is really understanding what pieces of that technology are going to be around or are worth spending time investing, the human capital aspect of learning that information. To me, we're seeing turn times continue to be faster, because the time to underwrite a file, where an underwriter could have 20 or 30 files per underwriter, now they can handle 60 to 80 or 100. So we're starting to see things become more efficient. On the loan officer side of it, it's getting answers quickly, right? If we have income that we need to, if they have 10, 15 properties on a rental schedule, where normally it would take on a to be determined situation a couple of days to get an accurate response, we're seeing those quicker. So, my opinion, the things looking for loan originators, especially in the broker channel, things are looking up, right? We've continued to take more and more market share, and I believe delivering on what are the three most important things to all of us in this industry is pricing, speed, and execution. And you just watch brokers continue to grow with that market share as those three main points continue to get better. And I think technology is helping us achieve that even at a faster pace.
Andrew, any thoughts on that?
Yeah, of course. I mean, I could just say, from a micro, maybe from a New York origination perspective, realtor centric, I just feel technology is great. I have found he or she who makes the calls wins. So I found a little grit and grind and hustle that can't be replaced yet with AI. I mean, there's some great tools. Can't say enough about UWM and Mia and all these different AIs. But I will tell you that at least our experiences in the last quarter, I guess sometimes when it gets more difficult, maybe LOs, they, kind of get paralyzed or whatever. We have found if we just double down on the business development activities, I don't feel the technology. I think technology, everything that Tom said is exceptional. I think that's, on the back end, on the broker side, retail cannot compete with us. Bankers can't compete with us. But I will say there's nothing better, Matt, than a good old meet a realtor for, a cup of coffee or a beer, or if you're a Jet fan like me, probably a hug after consistently losing. But, like I say, he or she who makes the calls wins. I have found outside of technology, it's just those willing to, no matter who you are, top producer, new LO, I don't think there's necessarily an advantage. It's just a relationship game that we're seeing, and it's really successful for us as well.
As a Cincinnati Bengals fan, I feel your pain for sure. It has been a tough season for sure. Damon, any thoughts on this topic?
Yeah, kind of marrying both of what Tom and Andrew says. Yeah, we're heavily invested as a small business in our tech stack. I can see a path with these great new tools and AI and other robotic processes speeding up the experience for the borrower, the turn time back to the realtor or the listing agent or the borrower, and what they can qualify for. We're playing around with a run my day type of dashboard for our LOs. We run a lot of analytics as the owner of the business. I've candidly failed our LOs a bit by not running enough analytics for them. So trying to, use the AI tools and just some of the newer, greater technologies to give them more visibility on who's calling who are your referral sources, who needs attention now, who should you be going after for a lead. But to speak to what Andrew said, there's I think more than ever, a desire to pick up the phone and spend a few minutes talking to your clients or your borrowers and get that human connection. I was just at a conference, and I think one of the big guys, it was either UWM or Rocket, the refis with the AI tools is a big game changer. But on purchases, uh, the automated loan process is still not basically running the day. The individual originator knows what they're talking about, is winning those deals, because likely the real estate broker wants to talk to the broker who knows what they're talking about. The borrower might have questions outside of what the chat might be able to articulate. So I see an opportunity for these tools to make good, strong, fundamentally sound brokers into super brokers, and those who are not using it to have a more difficult time originating loans.
Well, we talked a little bit about opportunities. Let's talk a little bit about challenges. We'll start with Andrew on this one. What are the biggest challenges facing LOs and brokers, both now and in the coming years?
I think one of the biggest challenges, especially in our area, is just pure inventory. So you really have to stand out as a loan originator to kind of help your client, to help them get an accepted offer, to get that realtor's business. So we try to turn the issues of the more, problematic things into benefits. So as an example, one of the things that we do to try to capture more business, I kind of consider it, there's less pies and I'm a big purchase guy, less pies of pizza. Let's go, and I'm a big guy as well, but unfortunately, let's go after more of those slices for the less pies. So one of the things we do is we call like the buyer hype up call. That's really big for us, where we call the listing agent and tell them how the buyer is the best thing that ever happened to them and how fast we'll close. So I find some of the disadvantages purely if you're a purchase shop, the inventory, especially in areas where there's not a lot of new sales, mostly existing, just becomes problematic. There's not that many sales to go around, and then it's even more difficult for the loan officers. But I try to take the situations where it's maybe more problematic or less business and turn it into bigger wins to, like I said, I feel like the win is getting more slices from a shrinking pie.
Damon, what are you seeing there?
We're in a mature, we're basically in big cities. We focus our originations on, California, Texas, Florida, bigger cities. Our average loan size is about $2.5 million, I think right now, maybe $2.25 million. So one, affordability, and two, what Andrew's saying, inventory. I mean, I have never in my 20 years had so many pre-approvals that just die off because the borrowers cannot get into what's considered affordable housing in the great state of California here, or especially Southern California. I mean, you're talking about starter homes in some areas at, $2.5 or $3 million.
You just tap out, right? Just literally tap out.
It's just like, even if I can get you the loan, do you really want this like stress every month? Like 49.9% of your income is going to your mortgage payment before you spend on the kids or whatever. And I think that speaks to when you get to know your client too, like, hey, this might not be the answer you want, but like, let's really think about this intelligently and figure out if this is a good move for you. Are you going to be so stressed out that it doesn't make sense economically or for your future, because you're just going to be working to pay your mortgage every month. So we are seeing, and the irony of that is it's people who are, in the upper cohorts too, sometimes that, are living what you consider the American dream, making $500,000-$600,000 a year in some of our markets and still not being able to buy a home. It's a little disturbing in my mind about that. That's a little bit concerning that those kind of profiles would have such a tough time finding a house.
Yeah, it's definitely concerning for sure. Tom, your thoughts on the topic?
The topic of what's the most challenging for loan officers, I'm going to speak mainly in the broker channel, is really retention. I think when you look at a competition standpoint of, if I'm not mistaken, Andrew and Damon were both all heavy, we're all heavy focused on purchase, because that's really what propels us and keeps the lights on even in bad markets. However, looking at a retention rate, I think the broker channel averages between 15 and 17% for a retention rate, and our competitors are at 90 to 98.
So that's really bad, right? That's really bad.
Really bad. So to me, it's been something that our focus going, into this year is looking at, okay, well, how do we combat that without stepping on the toes of originators that have built their own book of business? And it's really trying to identify ways to where, is there a way that technology can help with that? Or does it just boil back down to what even Andrew said and just got to pick up the phone and we got to make sure we're making these calls. But to really look at moving that needle as a section of this industry, I think it needs to happen, right? Because what it's letting us know is that we're not servicing our clients as well as some of the companies that are forcing people to make those phone calls. And, what can we do to get better to where even, any one of our companies, if we increase to 10, 15% on a retention rate would be, everybody would be eating. It'd be outstanding. So that's the biggest challenge, I think, of the broker channel. Other than that, everything has been, on the purchase side, we've continued to grow and are still taking more market share. But that's an area that we've been kind of stagnant on. And we see a lot of the players in the TPO business trying to step up and put things in place to help with it. But it still really boils down to, as leaders of our own organizations, how do we make that difference within our own company? So for me, that's a big focus for 26.
We've talked a lot about technology already. I'm sure there's going to be at least part of this next answer, and we'll start with Damon on this one. What is the biggest change in the way that you've run your business in the last few years?
Two things. When the interest rates had the Fed went on this jumbo rate hike cycle, the rate of change was very, very fast. And our firm had developed some very good relationships with small banks and credit unions around California predominantly. And those guys, they basically ran out of gas. They couldn't fund any more loans. They had loaded up on long dated treasuries plus, inexpensive mortgages relative to what was going on. So we literally had to restructure our business and had realized at that time relying on a few lenders was a great way to scale your business and really get a strong flow going. But if you hit a tough market, boy, man, did you get a double whammy of not only rates going up, but your lenders saying we can't do any more business. So that was a big wake up call. I mean, a known problem potentially, but still the rate of the speed at which it happens, you can never adjust for. So that's pushed us into some other products. Another line of business for me, I've gotten into the bridge lending business for developers as a separate business to Insignia called Insignia Capital Corp. That's working with a lot of local developers and builders. And that's been a nice complement because we can get the client the bridge loan to buy the property. And then once they stabilize, incentivize them to call us for the mortgage side to give them the perm loan. So just being creative like that. And then just on the tech front, just spending more time really trying to understand. I mean, like Tom and Andrew were saying, you got to make the tools work for your sales team. Our sales team's well over 40 years old. They're not technologists, right? Like you can't build something that's so complicated that they're never going to use it. So you got to try to find a way to get the buy-in by making it easy and intuitive, and let those guys do and those folks do what they do best, which is go sell mortgages, right? You don't want them to be sitting there trying to figure out how to run their day on a on a CRM if it's not what they like to do or what they're capable of doing. So that's been the challenge as well on the tech front.
Yeah, it totally makes sense. As then there's so much new technology out there. It's definitely a challenge. Tom, what are you seeing as far as changes? What's been the biggest thing at your business?
There really hasn't been many changes over the last few years for us. Everything has been fairly consistent. If I had to choose something, though, and I don't want to, 'cause we'll probably tie into one of the future questions, is really accountability, right? And understanding what is the accountability of a broker. Even from a regulatory standpoint, there's it's still, I think, when a lot of our legislation was written for Dodd-Frank, there wasn't really verbiage of how people would operate as a broker. There were some parts in there for people with mini correspondent, and it was more of like a temporary way to operate before going fully delegated. There's been, to me, that's really been the only change. Outside of that, the business has been the same. It's just they think you're going to have to start doing more business to make the same amount of money. And we've been hearing that for a while. We're starting to see that trend a little bit start to come into play every year a little bit more, where loan officer compensation may be coming down a tad bit, but they're doing more units. So I think that's part of the whole technology piece and making things faster and easier.
Yeah, totally makes sense. Andrew, how about you?
Yeah, if you're going to throw tech in there with social media, I mean, that's a big thing for us. So, I don't know if you guys can see, I'm 6'3", 250 to 320, depending how many bubble burgers I eat for the jet tailgate, true story. So a couple of years ago, 2.5 years ago, our value add to realtors is we actually help them grow their business on social and digital, and we have services to do so. So my team's like, hey, Andrew, you own the joint. Why aren't you doing this whole social media thing? So I dove in. My first videos 2.5 years ago were horrific. I'm very intimidating if I don't smile. So my first ones were absolutely terrible. Then I found my groove. I have two little daughters. They're 7 and 9. So, back then they were 5 and 7. So I've kind of found my groove. It's definitely helped. I've been on vacation and in the infinity pool in Mexico. So I was like, wait, I know you. I'm like, uh-oh, here we go. He's like, you're the guy on TikTok with the Sharpie doing the, to all the points here, Damon's point, the 49 DTI, and everyone's hating on you. I'm like, yeah, that's me, the guy with the Sharpie.
Actually, I know who you are now. I think I've seen a couple of your videos.
You have the Sharpie, like, hey, how do you give someone this much of a mortgage? Like, it's super incendiary. But I've for that I've doubled down. I feel like YouTube is a play that not many originators have really dove into and really done it consistent. So just like we have coaches and great coaching groups across the country, I've kind of dove into some YouTube coaching groups, believe it or not. And I feel like if you think of mortgage and YouTube, you think of some people doing a daily video, kind of just like riffing, or I didn't think that anyone like led the space. So I was like, you know what? For us, non-QM in New York has been exceptional. It's bridged the gap for refinances from a profitability, from an ownership, from a revenue perspective. Plus, loan sizes are bigger, revenue points are higher. And on top of that, I feel clients actually appreciate us. I'm not saying that other clients don't, but sometimes when you have two teachers putting 30% down with 800 scores, they're price shopping even on the broker side. Sometimes we try to keep up with credit unions. On the non-QM side, I feel like because the FDICs and credit unions don't offer the product, we as brokers are really appreciated. So I made a commitment starting like June, July, August to do 2 non-QM videos a week for YouTube. So in a year from now, I should have over 100. It's one of those things. It's like, thank God I have my main business because it's a slow burn. But we are starting to see, the reach out. So we have, people that are having issues working with the wrong companies and getting some save me deals there and some new clients, which is cool. But that's my tech big thing is I believe if I do 2 videos a week, which stresses me out because, we got deals and fires and realtors. I promise in a year from now, I'll be the guy on YouTube that is the non-QM guy. That's my goal.
I think, Andrew, can I add one thing to what Andrew's saying? I think he said 2 important things. Number one, consistency. I tell we're a small group, right? I tell our sales guys, you've got to do it for a few months for it to pay dividend. You can't start calling these your brokers or start sending out a marketing piece or trying to drum up business somewhere. Do it for 2 weeks and give up. It's a 3 to 6 month. Why am I doing this? And then somehow by either the stroke of luck or it just sinks in with that group of people you're going after, someone will call you on something. And then you close that deal, and then you become the person that they're trusting for that. And I think transparency is really important. We get a lot of deals that come to us. The client's never going to qualify, or it'll be very difficult for the borrower to qualify for a traditional bank loan. The credit income's too choppy. It may fit a non-QM loan. It may fit one of these boutique banks that we work with that are willing to individualize and underwrite. We give them an honest answer. They disappear. They come back 3 weeks later saying, hey, the bank or the broker who said they could get me that deal, they can't. You guys were honest. You gave us what we could get. We trust you to take us to the finish line. We see it all the time. So I think the transparency and being honest, even though you might lose the loan, but give the client the right feedback is over time is the way to go.
Yeah, absolutely. Honesty is always the best policy. In the end of the day, the customer is going to appreciate that. A couple of current events type questions for the next 2. One, Tom kind of mentioned it a little bit already, but we kind of want to dive a little farther into it. The CFPB, everybody's favorite topic, back in the news as the current administration continues to work towards potentially shutting it down. What has the shift to state enforcement meant for your business? And are there any other regulatory changes you'd like to see take place? And let's start with Tom, since he's already kind of mentioned a little bit about the compliance side.
The current leadership will change. It always does. It always will. but the industry is going to continue to, we're the largest access to the wealth that the country has, right, is in real estate. So to me, we have a very important job to protect it, and to make sure that we don't fall to things what happened in 2008. So regardless of what happens to CFPB today, it's our job to operate within the parameters of what has been set. The tricky part with that has been, now that CFPB may be exiting out or come back in from time to time, depending on the current leadership, they're still going to be looking at the stuff that's being done now, right? So those that are in this industry for, the next 20, 30 years, it's important to make sure that, if we think and we hear these things on the news that, okay, hey, the CFPB is, now it's going to be done with. It's not. It's going to come back. And the items that you're doing today are going to be looked at. And when we're looking at things from a broker standpoint on how are you managing the things that states are not looking for, right? We're under audit typically about 5, 6 states at a time throughout the year, because we're in 49 states. So at some point, a lot of them are asking different things. And now that we've seen the CFPB kind of take a back seat, a lot of those states are looking at federal regulation and kind of making their own guidance on it, which to me has been a little bit troublesome. However, we're so heavily regulated. If you look at how many people that the majority of us are having to be accountable to from a legal perspective, in some instances, depending on how you do business, it can be anywhere between 12 and 15 different governing bodies that we have to either walk through audits with or have submit reports to. There's so much of it that it would be good if it was one single spot. I guess we have a state license and a federal license, federal laws to uphold, but there really hasn't been a challenge with CFPB being gone or here, right? I think the biggest challenge for any of us that are in the broker channel is understanding how to operate, because you can't call them and say, hey, I have a question for you. If my loan officer they're going to say, well, here's the guideline, read it. Well, the guidelines sometimes weren't written for brokers that aren't funding their own loans or even disclosing in their own name, to where it's been a little tricky, to where I think a lot of brokers just try to do the best that they can. And we're so heavily regulated that I don't think, as we've seen market share grow, we got a lot of people that were punched in the mouth from 2008. That all they want to do is run a good business. We want to help people. We care about the consumers in our market, to where I think there definitely is overregulation, where I'm happy at this point things have taken a step back. But as we've seen the CFPB step back, we've seen some states then start to make up their own guidance on federal regulation. So it's been a little bit tricky. So if I would like to see anything, it would be great, similar to how they do a multi-state like a multi-state audit, if you're having one, similar to where they at least have the federal tied into it, maybe even some sort of a help desk to where they can run things past them for a lot of smaller brokerages, because the majority of the brokerages in our industry are the ones that have 3 to 5 people, right? That's probably 90 to 95% of the brokerages that are in this country are really what they would call mom and pop shops, or a group of friends that really just want to help people and, don't want to have their margins stepped on. So they open up a brokerage. Well, where's the help for them if they want to get it? Because a lot of it was designed to, regulate large publicly traded banks, where most of the mom and pop broker shops aren't even close to that. They're just, they're trying to help people. They have a great access to cheap money and good service that they provide, to where it'd be good to have a little bit more information.
Yeah, it's great insight, Tom. Andrew, any thoughts on this?
Yes, that was very good, Tom. That was a very, very good answer for, it's like putting politics on social media. It's like, try not to, that's great.
Yeah.
No, that was great. It's the truth.
Thread the needle.
The size of Tom's organization, which is huge, us is like a microcosm. It's just more, if you think about the business as a whole, you do good business and you get in trouble for stuff or a violation. And did you know about it? No. Did you call and ask any about it? No. Are they very basic, objective questions? You should be able to call and say, hey, the sky is blue, right? Yeah. But there's no one to call and ask that the sky is blue. You didn't know it was whatever color we're going to call it today. So it's interesting. It's one of the things, like, you can go out, do a great job, earn your income for your family, and within 3 years, whatever amount of time, have someone come in and say you did it wrong. So, that's why we love the mortgage business, but I do hope it improves. I think it would be fair, especially for the broker side, to Tom's point. It wouldn't be great if it's not like we're trying to cheat or, like, just tell us how do we pay loan officers? What's the best way to do it? And even if you think of the mortgage side, right, there could be 10, specific lenders you work with and only one will do the deal. Even on the guideline side, it's the same thing. So, I don't know how sometimes I don't know, Tom, your backstory, how you guys, or Damon, how you guys got in the mortgage business. Sometimes I'm like, where did I decide that I was going to go from master's in psychology to this field? We definitely love it, but wouldn't it just be great? We're all great, objective humans. Just tell us what to do.
I think that would be nice for everybody. I think it'd be very easy. Damon, anything to add to that?
No, just kind of what Andrew was saying, smaller shop, can't spend a fortune on legal and compliance, but we do budget that and have a, full-time NMLS, Department of Real Estate attorney, have an outside compliance group for our other states that we have on retainer. And sometimes they don't even know the answers, to be honest with you. So it's, you sometimes just do the best you can. And it's not like the regulators, if you even go through your attorney to ask, how would you respond to this issue? They point you back to their manual and say, well, it's in there. And it's pretty frustrating sometimes, especially if you're like, to Andrew's point and to Tom's point, if you're trying to do the right thing and these rules are opaque and, like Tom said, designed for huge corporations that can have a bunch of corporate attorneys figure all this out and a management team to design the rail guards. But so many of our broker friends out there are small businesses just trying to, navigate, and they might even get the wrong information from their lenders who sometimes don't have the right answers. So it is a challenging market sometimes in that regard. So just do the best you can.
Yeah, it's all you can do. It's certainly a challenging area for big and small brokers. Another news story that's been, and I'm curious to get your guys' thoughts on this. We've heard some interesting ideas, we'll say, from the government of coming up with ideas to deal with housing affordability, everything from 50-year mortgage terms to portable mortgages to more assumable mortgages. We'll start off with Andrew on this. What ideas are you hearing out there, whether it's the government's or other ideas that would actually help? And what are some other things they should consider?
Honestly, my only feedback based on all that is it was the biggest blessing for me. Why? A reason you wouldn't even think, because it gave me the opportunity to do short form content that's so out there and ridiculous. It's like, oh my God, this crazy new thing came out from the government. You have to watch and follow, and we ended up getting more leads and opportunities just because it was a marketing play for us. But, I have my feelings about it. I think, in fairness, a 30-year fixed rate mortgage in the 6 to 7/8, some would call it a ripoff. I think you pay back 2.5 times what you borrow. I couldn't imagine a 50-year. It's the same thing with an adjustable. I say, listen, if you can't afford this payment and $100 a month moves the needle, you probably shouldn't be buying this house at all. But to me, listen, ideas are great. There were so many ideas, with multiple presidents, none came to fruition. So for me, I use it as a self-centered advantage just for aggressive Instagram marketing.
I've heard a lot of stories last week because of it, so I'm not complaining either. It certainly gave me some content as well. Damon, your thoughts on any of this stuff, or any ideas that you might have that might be different than what's out there?
I mean, the 50-year mortgage it's if you do the math, it doesn't make a whole lot of sense. I would have just say, why don't you just do a 20-year IO and then convert it into a 30-year loan? And if the client wants to pay down over that 20-year, give them ability to recast the loan automatically with a additional principal payment. But that's just a thought I had right now. Haven't spent that much time on it. Candidly, jumbo-oriented lender. Most of our clients are looking at the yield curve and saying, I'll take the shorter duration loan, 7 years or 10 years, because we don't, we're not going to be here that much longer. We'll deal with it later on. So, but, the only posit I would say out of that is the fact that the government is aware that there's an affordability problem, or the administration. They're trying to come up with some ways to, get some activity, at least in the existing home sale market, which has really been stuck.
Yeah, absolutely. Tom, what are your thoughts?
I liked Andrews. It was made for some good content creation. I mean, the reality is there is a problem with affordability, right? I think even for us, that's why, if you would ask me 10 years ago, would I do chattel or chattel financing? I would have said, no, we don't finance cars. We do mortgages. And however, we've started doing them and we do a lot of them because affordability has gotten to the point where, if you have a family, I live in Minnesota, so you figure if somebody makes 60,000 a year, but they can't, I mean, you can't really afford to have a house and food. Like you got to come up with something. So to me, whether or not it's a 50-year mortgage, I don't think it's a great idea. However, if it helps somebody get into a home, when we look at it instead of where the lens that I think a lot of people view it with is their own lens, and saying, for me, if I was going to buy a $700,000 house, I'd spend so much more in interest. It's crazy. However, I think when you look at it for, hey, $100,000 home, what does it do for the payment? It sometimes can be 10% less in overall payment. So it could be right for the right person, right? Financially, you could go anywhere on the spectrum on this. You could say paying interest is bad at all. You should do a 5-year loan. Let's be realistic, right? Everybody has a different way of doing things. Home ownership would still provide more value, even if it was a 50-year mortgage, than renting, because they are still getting the tax deduction. They are still gaining equity. I don't know the answer, right? If I did, no, I wouldn't run for politics regardless. I was going to say I would run, but that's not happening. Hate politics. To me, one of the things that I've seen work, at least in some areas, is leasehold property, where the government's buying the land, and then in the cost to build, if it's a $200,000 house on a $200,000 piece of land, the government owns it to try to help more affordable housing. I've seen that work. Portable mortgages, I think, are a horrible idea, but that comes from my perspective because I run an origination company. I have friends in Canada that have a portable mortgage. I personally, if I could use it, it would be great, but for my business, it would be horrible. So I think that the way our economy has ran from the way that mortgages are done, I think it would be detrimental to to not only our industry personally, but to the markets as well, for how many jobs and everything is attached to the mortgage sector of our industry, to where I think there would be a lot more secondary products, because even similar to like a VA mortgage is essentially portable. Not really, it's assumable, but somebody can assume that mortgage. However, the majority of people that are doing that then have to come up with the big chunk after. If they have a $200,000 assumable mortgage, but the house is $400,000, they got to come up with another $200,000. So I think there would be a different sector that would open more people in second mortgages, or ways to be able to bridge the financing gap for it. But I definitely think there's something that maybe needs to be done. I don't know if a 50 or a 60-year mortgage is the answer. I think, we need to find ways to keep stabilizing housing and stabilizing the job market.
One thing I recently underwrote for a small bank, it was a more of a luxury deal, but I think it'll apply evenly, was we helped a client. He was building a modular home in Topanga Canyon area, and the cost to build was significantly less. We got this bank because they wanted to work with the client to do the financing. It took us 3 months to figure out how to actually finance a ground up construction modular home. But looking at the cost, the combination of, you can get the square footage down on some of these more affordable areas with modular, you could really pump out these houses. And I people always think of modular like manufactured. Oh my God, I don't want that. I've spent a little time on this. It could be a potential solution to bringing down the cost of, because if inflation doesn't come down, at some point rates are only going to go. I mean, how much further can they go, right? So we got to come up with the solutions on the inputs. And if you want to buy a home and improve it or whatever, how do you get these costs down? I think is the bigger question.
That's a great point. Modular homes in this area in Ohio, where I am, are big, and then a lot of them are really, really nice. And you would never be able to tell it's a modular home otherwise. So that could very well be a solution. But yeah, we'll see kind of how that works out. Just about ready to wrap up. We got one final question for all of you, and we'll start off with Damon. As we look ahead to 2026, we're almost to the end of 2025. What do you think the landscape in the mortgage industry is going to look like in the new year, and how should brokers prepare for the challenges and opportunities ahead?
I think those that are committed to the business, with some of these new tools that are becoming apparent, AI, again, speaking of that, uh, different types of processes that could really supercharge you. I think it could be good. I'm a little bit nervous on rates. I don't know how much lower they're going to go, but still much better than they were. So I don't think you can rely on rates being a tailwind for your business. If it happens, it's great, but prepare as if it wouldn't. And and I just think, it's going to remain a better environment, but still challenged. And, take advantage of it. You earn your stripes in hard markets. Everybody can do it when rates were 3%. We didn't work. Looking back, we didn't work as hard as we thought we were working. Now we're working really hard. So I think, you earn you grow your business, you grow your reputation in more challenging markets, and you develop your niche. And then when things do, I do see a path for rates to come lower over the next couple of years. Uh, you've kind of planted those seeds, and you can really harvest them as at the right time.
Absolutely. Tom, what are your thoughts for 2026?
No, I think we started to see the shift a little bit to where I hate to use the word influencer, but Andrew now, since he's the TikTok influencer, I want to call him that. I think that we have to use where we're at with it, right? The ability to touch 5, 10, 20,000 people in a day, where before, we used to do a lot of TV and radio, and I would have to spend $100,000 to have so many impressions. It's now, you can't, there's no point in doing that. Now you have it for free, but you need to teach people, right? People want education. And I think the younger generation has been given everything that they wanted without commitment. And that is the culture that we created. So we need to market that way. I need to go on with a Sharpie and do explanations of, okay, teach me what a 50-year mortgage looks like. Why do you think it's a bad idea? To where you actually you're going to have to work twice as hard at that aspect, where before maybe it seemed like fun, but that's where the business is, right? If you can reach not only your past clientele, your real estate agents, everybody through something to where for me, outside of watching football on TV, I don't really watch TV anymore, but I've spent time on social media. I know what my friends and family are doing. Majority of people have switched from watching television, my opinion, to staring at their phone. And if you're not leading with the knowledge or education that people want, somebody is, and that's going to take that business from you. So I think, 2026, I think we're going to start seeing it more and more. The influencers, the people that are leading from an education standpoint, mixing things in that are fun, it's going to become he with the most or she with the most friends is going to do the most business. And I really think that's the way it's been, but it was a lot harder because then you had to be connected through country club membership or golf club or yacht club or wherever you did. Yeah. Now to where you'll see, 18, 19-year-olds coming up because they're willing to do they're willing to go on. They don't have the reluctancy that some of us do at our age of doing the social media aspect. I think that's what it's going to continue to grow, that aspect of the business.
Andrew, we'll let you wrap it up. What are your thoughts on 2026?
Well, the Andrew Russell wrap up for 2025 it's everything we said on the call. It's a mixture of what do you do when the phone rings and what do you do to make the phone ring? And you just kind of marry those together. It's like chicken before the egg. What do you work on first? I've known loan officers that make their phone ring, their marketing, their biz dev game, their social media game is tight. But then that happens at scale, and then they drop the ball with all their realtor partnerships. But if you kind of perfect with technologies and with your team, and if you build it, they will come, Kevin Costner style, which you guys know, you have to pay all these fixed costs, will then grow into it. That's difficult, especially in this market. You don't necessarily know where your next deal is coming from. So I do think it's a mixture of the both. It's working on all the technologies and really geeking out on your team to have a flawless, hopefully tech-first process when the phone rings, but also doing the land, air, and sea stuff to make your phone ring, which is, to Tom's point, the BNI groups, the boots on the ground, the belly-to-belly, the social media stuff, absolutely. You can't do any worse than you're doing right now if you're not doing it, so you kind of marry that all together. But I do feel there is no secret sauce for next year. There is no pill you can go and take, right? There's no Ozempic to lose weight for, the mortgage space to do better. It's the truth. Unfortunately, it's just, You have to have a great process, which is why we're brokers, right? Without a doubt, it's been shown we save clients money. We're the best, fastest, all the good stuff. But how do you make your phone ring? It's land, air, and sea. You really have to do both things. So remember, as mortgage professionals, sometimes like, what do? I do mortgage. I'm a technician. Well, you're also a marketer. That's how you make your, typically, if you're an outside sales guy and you're not getting leads from your company, which is a blessing, I'm a marketer. I do business development. That's a completely different, hat, a different tool set. So those are the two things. If you focus on those two things, you'll crush it next year.
A lot of things for brokers to focus on for 2026, but if you follow all that advice, you're going to end up with a great year, no doubt about it. That's just about going to wrap things up for this edition of MPA TV. Gentlemen, thank you so much for taking the time to join us, and I wish you all the best of luck and continued success in the new year. Thanks again to our guest, and thank you for watching this edition of MPA TV. For my guests, I'm Matt Sexton saying so long, and we'll see you again next time.